Welcome everyone, and thank you for your time. We're going to start off today talking a little bit about the strong results for the continuing business, which is the Blancco Technology Group. We're going to talk about how we finished very strong across the traditional metrics, which are revenue and profit, but also equally importantly against the KPIs that we set for ourselves, such as changing our geographic mix, modifying our product mix around the world, getting some of the next generation products sold, introducing new technology, and broadening our team. As we get a little further in the presentation, we'll be more specific about leadership roles that have been added. And we're also going to talk about the conclusion of two acquisitions we made in the year. Towards the beginning of last fiscal year, we acquired a company called Tabernus, who is also in the data erasure market space out of Austin, Texas. That entity has been fully integrated, and their leaders are now part of the global leadership organization and performing well. We also concluded the acquisition of a company called Excalibur in the diagnostics arena. We concluded that in March. Their team is fully integrated and executing as well. One thing we'll talk a bit more about is the integration of technology between Excalibur, which is the diagnostics platform, and the Erasure platform, and it's specifically targeting a market which we believe has a phenomenal addressable market opportunity, and that is the mobile device upgrade market. And again, we'll talk more about that later. Finally, when we get to it, Joe can touch on the exit of the repair services business as well as digital care. As the highlights or just a quick spotlight on the business, we are a fast-growing entity. We grew at 49% last year. Our gross margins were at 92%, and our AOP margin was at 34%. We have roughly 225 employees around the world. We're chasing an addressable market that's north of $4 billion, and we're in 15 countries with real sales operations and real support operations around the world. We have a very real business. So without any further ado, I think I'll turn it over to Jog, who can take you through some of our financial highlights.
Thank you, Pat. Blancco's had an outstanding year. We're really proud to present these numbers, which is the first full year end with Blancco as a standalone software business. We delivered 22.4 million of revenue. That's 49% growth on the same period last year. That number is in line with consensus, but most importantly, we've grown in the strategically important areas, which I'll talk to you about a little later in the deck. The top line revenue growth is translated into bottom line profit growth, and we've grown over 50% to 6.1 million. Most importantly, we've maintained our margin, and that is against a backdrop of making significant investment, which I'll talk to you about on the next slide. The cash generation remains strong with a 98% cash conversion, and we've almost doubled our earnings per share. If I move on to the next slide, on slide 8, I'm going to talk to you a little bit about the detail of the results now. We made significant investment during the year. Blancco is the market leader in a very exciting and high growth market. We said 2 years ago when we bought the business, to maintain that leadership position, we would continue to invest in the business, and that's what we've done over the last 12 months. The first investment, as Pat has talked about, has been in Tabernus, which we acquired in September. That contributed 1.5 million of revenue in the year, but also brought with it a great management team, a North American sales team, and most importantly, new technology. That technology has been fully integrated with our own. We also acquired Excalibur in March of this year. That is the diagnostics business, and brought with it the SmartCheck product. That has contributed 700,000 of revenue in the year. So that is from the acquisitions. We've also continued to make investments in our own technology through research and development. We've spent just over 10% of sales on CapEx, and most of that is in the R&D investment. That has been to continue to develop the product, launch new versions of it, and upgrade it for new OEMs, device types, or different OSs. We've also continued to invest in our people. We've invested in the senior management team, and Pat will talk to you about some of those names a bit later, but that investment has been to scale the business for growth. We've also continued to invest in the sales team, not necessarily in the quantity, but more in terms of the quality of the heads. We've grown our sales force, particularly at the higher end, and this has been important to help us win bigger deals, which I'll show you a little later in the deck. I'll pass it back to Pat. I'll talk about the operating highlights now.
Thanks, Jog. Under operating highlights, we're going to focus on three key areas. The first is the building out of the team. With the team, we started the big effort in 2016, that fiscal year, which ended in June. And in there, we were working on some operational roles. The first one that we filled was the head of global research and development. That has been filled by Khaled Alaberry, who was also the founder and CEO of Tabernus, who's integrated all of our R&D operations from Pune, India to Joensuu, Finland and beyond. The next was somebody to run product management. Russ Ernst joined the team this year. Russ is the best product guy I've ever worked with, and he's clearly providing leadership in that role. And then we also brought on Jesse Kittleson to run our global customer excellence and support program. So a series of serious management layers were added in 2016. We began this fiscal. We added some chiefs, senior level people to the mix that were not there before. We brought over Steve Holton as our Chief Revenue Officer. We'll talk a little bit about his background further on in this presentation. The next person we brought on was Mr. Richard Steenan as our Chief Strategy Officer. Again, we'll talk about his background a little bit later on. And then ultimately Keith Butcher, who's not here with us today, as our new Chief Financial Officer. Keith brings about 15 years of AIM listed CFO experience, so we're very excited there. The next section we'll talk a bit about is product and technology. At the beginning of last year, we talked about a few things. One, we needed to have our new and next generation products take root, and we need to sell more of them. So we're proud to announce that our live environment technology sold very well last year, and its results were up 188% on the previous year. Following that, we continue to entrench our position as a category leader with our patent portfolio. Our solid-state drive patent was awarded in the latter part of 2015 in Europe and in the first part of 2016 in the United States, and we are pursuing other jurisdictions as well. And on top of that, as we said earlier in this opening, we had created a new integrated product between the diagnostics platform and the Erasure platform, which speaks specifically to the mobile device upgrade marketplace. That has penetrated the market quite nicely. Blancco has always traditionally had a stronghold or a great relationship with the IT asset disposition vendors in the world, and that has continued to parlay in the mobile upgrade market space as well. Following on that, we had our first big carrier win out of the United States. This particular carrier is extremely well regarded. We were charged with deploying to over 5,500 retail stores in a very short period of time. We accomplished that in a 6-week window, and we have transitioned to local support and remote support from one of our top development offices. So that's a super success story. It's also important because the diagnostics are an early adopter industry. We got one of the biggest carriers in the world to get on board and to deploy in their retail environment. Finally, we've been upgrading our systems behind the scenes to further support growth. Things like NetSuite as our finance system, Marketo for marketing, and Salesforce continues to be refined for our sales and pipeline management. Lastly, let me talk to you a little bit about our geographies. When we began last fiscal year, we told our investors that a geographic mix that was greater in the United States was important to us. At that time, we had a mix that gave us about 20 to 25% of our revenues coming out of the United States and North America. This year, we had big movement. Through the acquisition of Tabernus, we added several customers in the United States. Their other founder and former head of sales now runs sales for us in the United States, Joe Mount. He has successfully built that team. North America grew mostly organically for us last year at a rate of 146%. It is now 39% of our group revenue, so a lot of success in the North American category. So well done there. Jog, we turn it back over to you for some operational KPIs.
Thank you, Pat. About 6 to 12 months ago, we decided to share with you, our investors, the operational KPIs that we use internally to run the business. The reason for doing this is that the KPIs represent milestones on a multi-year growth story and strategy, and therefore they're here to show you our progress against that plan. The first important criteria that we were going to focus on was the year-on-year growth, and I plotted that on slide 11. So I plotted here the half-year performance for each of the last 8 reporting periods and the year-on-year growth percentage both on a like-for-like basis and a total basis. What you can see, if you look at the grey box, is there's been a very significant step up in the year-on-year growth rates from the 20s to the 40s and the 50s now. That's been part of a planned approach, and that's been achieved through investment in sales resource, as I've talked about earlier, but as well as growing new customers, new products and new geographies. The second thing we've done to maintain our growth percentage is also look after our existing customers, which are really important to us. And I've put a little bit of data on the next slide about that. Blancco has industry-leading retention rates. On the left-hand side chart here, I've plotted the renewal rate by logo over the last 12 months, and you can see it's been consistently high at 91%. On the right-hand side, I've plotted the same metric, but I've looked at the renewal on the dollar, and it's 113% and has been growing. Those increase in the renewals is because we're upselling new product or existing product to those same customers. If I explain how powerful that renewal percentage is, to illustrate the point, we closed with 22.4 million of revenue in FY16. If we adjust that upwards for the fact that we bought Tabernas and Excalibur during the year, the brought forward run rate for 2017 is 23.6 million sterling. If I then adjust that upwards again for the renewal rate from those existing customers that we would expect to renew and spend more money with us, that becomes an adjusted run rate of 26 million sterling. The city consensus number for the FY17 year is 30 million of revenue. That means that we've got good line of sight from our existing customer base of 80 to 85% of this year's revenue ask. That gives me a real good feeling and gives me certainty over the next 12 months and onwards. The next slide, I've plotted the ARPU, which is the average spend per customer for our key customers. Our key customers represent the top 300 customers out of 1,400 customers that spend over 100,000 euros of revenue with us a year. You can see that ARPU has ticked up very nicely and is now over £52,000 a year. Most importantly, and which we're particularly excited about, is the growth in even the bigger customers. So the fourth bullet I've plotted here is the number of customers that are now doing over 100,000 of revenue with us per year, and that's grown steadily and is now over 32 customers. Most recently, Blancco has also signed its first 2 customers which have over $1 million of revenue a year with us. There's been a nice uptick in the average ticket size. It's also important that we continue to grow in the right areas, and so far I've talked about our existing business. So on the next slide I'm going to talk to you about our new business. Slide 15 shows our growth by product type. What we said to you 2 years ago is we're going to focus on growing our newest products. Those new products were the lead product and the mobile product. The lead product stands for Live Environment Erasure and is useful in 2 applications. One is storing data, to erase data in a cloud environment. Customers are increasingly storing data in the cloud rather than on servers in their own office. The second application is erasing data under the right to be forgotten, where consumers such as you and I can ring up Tesco and say, we don't want our data on your back office servers anymore. Please can you delete the data and prove to me that you've done it? Those customers can use our product to do that and prove it. The second key growth area was the mobile Erasure product. The mobile Erasure product is important because consumers such as you and I are increasingly using our mobiles to store more and more data. For example, in my breakfast this morning at Pret, I paid for that breakfast using my mobile phone. We're also doing our banking from mobile devices. It's increasingly important that data on those devices is managed. These 2 newest products, Lee and Mobile, now represent over 30% of our group's revenue, and they were 0 2 years ago. On the next slide, I put a little bit of information about our growth by geo. Pat has already talked about the growth in North America, which has now grown to nearly 10 million in revenue. As Pat said, that has been contributed to by the acquisition of Tabernas, but most of the growth has been organic. Most of the growth has come from signing bigger ticket deals, which is an outcome of the success we've had in recruiting better sales guys that can go out and win bigger ticket deals. The second growth area has been in Asia and rest of the world. You can see that's grown very nicely. As a result, we've decided to invest in opening new offices, and we've opened India, China, and MENA so far, and we're planning to open into LATAM as well. These emerging markets are proving to be exciting, and we expect to see further growth in those areas. The third region is Europe, where the growth has been weak. This is not a demand issue, it's not a product issue, it's simply been that we've had weak management in those areas. We've now fixed those problems, and the European growth is starting to return to normal levels above 8%. The next few slides show the detailed financial statements. They've been well covered by Paul in his note, so I won't go through them in any detail. Clearly, if you've got any questions, you can send a question through the question list. So I'm going to pass it over to Pat, who's going to talk to you about our priorities for 2017.
Thanks, Jog. We as a company have spent a lot of time and energy working with outside consultants, helping us understand what the most profitable and highly valued future routes to market would be, considering the technologies that we had at hand. We reviewed 28 different technology options and 13 different routes to market, and this is a culmination of those efforts. We have two strategic objectives as we move forward. The first one is understanding that we have a large addressable market, yet we are still a relatively small entity. And what can we do to open that up and take better advantage of it? So in that case, we have two strategies that we're going to employ underneath that. The first one, through research and talking with 1,000 CIOs and CISOs, we identified that their desire to utilize our technology is heightened when we plug into third-party systems, and we can access them via their existing service providers. So our core strategy, or one of them clearly, is working with other vendors so that we can access their enterprise class customers through existing service partners. The next one is increasing the erasure and diagnostic awareness amongst IT professionals. There's clearly a lack of understanding about some of the laws and regulations that drive people towards digital data destruction, etc. And part of our mission going forward is to make that a higher priority and communicating better with the CIOs and CISOs of the world. The next strategic objective is realizing and recognizing that we have a clear leadership position today in both the diagnostics and in the erasure businesses, but working hard to maintain that role and both of those categories as we move forward. So a couple things on this side that I'll talk to that give you an understanding of what we'll be doing in an effort to accomplish that. The first one would be embedding Blancco, erasure, and diagnostics into larger workflows. See, we see Blancco, for example, as a part of data or device lifecycle management, not as the whole picture. So in device lifecycle management, we see ourselves as end of life. Same thing with data. So we need to avail ourselves to third-party systems where we can plug in and they can launch data erasure directly from their management infrastructures. And these would be systems management technologies that are already in place within corporations around the world. So embedding ourselves in other systems management vendors' process is a big one. Another one I want to talk a little bit about here is maintaining leading coverage of erasure and diagnostic occasions. And some of this doesn't make logical sense until I explain it, so I'll bear down on it for a second. When we look at our business 5 years ago, it was very much a business tied to IT asset disposition, the end of life of laptops, desktops, and servers. Yet when you look at our revenue mix that Jog showed you just a few slides ago, you'd see that nearly 30% of our revenue today come from industries we weren't in 5 years ago, our live environment and our mobile technologies. As we look forward with the Internet of Things, there's so much technology presenting itself that needs to be erased in the future that the opportunities are really endless. But we're not going to try and solve every problem at once. This year, we're focusing on one in particular, and that is how do we erase the infotainment systems in the automobile industry? Because every time people are getting in their rental cars or their own personal cars, they're synchronizing their phones and all that personal data directly with that infotainment system. And there is a responsibility to present a renter of a car the ability to delete their presence. We see this as millions of new opportunities, so we are building out prototypes this year that we hope to take to market next year. I think lastly, and Jog talked about this a few minutes ago, is we're going to continue our geographic expansion. Through the acquisition of Excalibur, we now have a nice sales office in India. We are opening up in LATAM. We have opened up in MENA, and we have an office that's opening up right now in China. So lots of opportunity, very structured and very focused. If I take you forward, I'm going to talk to you for a few minutes about our addressable markets. I'm going to talk to you about slide 28. And on this, I'm going to talk to you how we've traditionally created our revenue and what we've added this year. Our traditional methodology are the blocks on the left of the three. The ITAD industry is quite large. There are about 600 ITADs in the world. We are in 550 of them. It at one stage was 95% of our revenue and growing. Today it's 40% of our revenue and growing. Critically important, but it's not our only revenue stream anymore. If you move to the right, you have another category, and this is the service provider. It represents about 30% of our revenue today. It's a group who buy licenses from us, and they wrap their own services around them, and they deliver these on-premise to their existing customers or as technology is transitioning in and out of their environment. This is a perfect vehicle for us to get to our biggest verticals: banking and finance, healthcare, public sector, and telco. The next category would be the enterprises that buy directly from Blancco. Most of these enterprises have got to a data sanitization strategy, largely because of litigation or legislation, and they're continuing to buy directly from us. The last block on this is our business development and channel route to market. This is brand new. We've added it this year, and we're looking forward to big new growth here as well. My next section that I'm going to take a little time walking you through will begin on slide 31. This is the first time we fully articulated our addressable market across all categories. This first is end-of-life erasure. This is how Blancco was founded. It was found in the market that served the ITAD industry. According to Gartner and IDC, we have about 2.2 billion devices for mobiles and PCs that are hitting end of life this year. That's the opportunity in that market to be erased. We see it as around a $2 billion market based on our own charge methodology. So, most of you would ask us very quickly, we go to the next slide, if that's a $2 billion market opportunity and you guys dominate that market, why are you not bigger? Well, we decided to take that to heart, and we went out and did some research. And in that research, we surveyed many corporations around the world, and this was their response for how they actually dealt with end of life today. And this largely helps us understand the opportunity we have going forward. If you notice on the top row, there's two in particular that stick out. The reformat, reinstall represents 39% of the respondents' methodology, and deleting is 11%. So 50% of the market falls into that category. And the unfortunate thing is neither of them delete or erase the data from those devices. It is 100% recoverable. So we spoke earlier about awareness and that being a part of our core strategies. We need to focus long and hard on communicating the difference between deleting, reformatting, and reinstalling, and erasure. That's 50%. If have your eyes to the top right, you'll see that free erasure was being used by about 6% of the respondents. In the bottom left, you'll see paid for erasure is about 8%, of which we're over 7% of that category. Towards the middle, you'll see third party, and that's generally the service providers that we mentioned a few minutes before. And lastly, you'll see that physical destruction is still used by 10%. If we move forward, we have a whole new category of data erasure, and we refer to this as live environment or active erasure. It took us a long time to get to this addressable market, so we did so in working with Gartner, and some of their most recent research talked to 90,000 businesses around the world. And in those 90,000 businesses, they identified that there's 6 trillion gigabytes of data that has corporate responsibility associated with it. And of that 6 trillion gigabytes of data, 1.3 trillion gigabytes will be currently available for erasure. And that's based on whether it's industries that have 7 years they need to retain, if it's on versions, copies, locations, a whole series of metrics. It's 1.3 trillion gigabytes of data today that are available. And the top left is a graph clearly showing that that's escalating. If we put our charge methodology against that, there's a $1.3 billion market opportunity today within the data center, the cloud, and other such storage environments for erasure. What we need to do a better job of doing is penetrating that market. So it's a very exciting opportunity for us. If we go to the next slide, we'll talk a little bit about our most recent investment and why we did it. Hopefully this will be brutally apparent. Our most recent investment was in Excalibur, the mobile diagnostics platform. So trying to understand this market and presenting to you an addressable market, we see 3 separate categories where our technology applies. On the very far right, you'll see the carriers. The carriers represent about a $150 million opportunity, which is great business, but there's more. The OEMs, which in many parts of the world are those who put the handsets in their customers' hands, represent about a $50 million opportunity. So combined between the OEMs and the carriers, we have around $200 million opportunity. The last and most interesting to us is the burgeoning mobile device upgrade market. Today we see that at almost a $600 million opportunity. And to frame it for everyone, that's what's happening right now. As the iPhones of the world and the Samsungs come out with their brand new releases, hundreds of millions of phones around the world are changing hands. And as soon as that happens, there are buyers on the back end that not only need to diagnose them for quality, but they also need to erase them for resale. And our new integrated combined technology is absolutely perfect for this market space, and that's the real reason we went after and purchased the mobile diagnostics platform from Excalibur. Without any further questions or comments here, I think at this point we can turn it over to questions from the audience.
Right, thank you very much, gentlemen. Yep, quite a lot of questions, so let's dive in. First question from Ashraf. Apart from Hanover exiting the share register of Blancco, have you seen any other institutional changes reflecting your transition in the business to a pure software model?
Well, why don't I cover that? It's a really good question. Yeah, there has been some institutional changes. Generally, that happened when we did the buyback of the shares in May, and I think the institutional base that we've now got represents a stable base who want to be investors, long-term investors in a software business. So I don't think you're going to see any significant change, certainly in the foreseeable future.
Okay, question from Peter on projected earnings growth. He's been reading the equity development note and sees that there is a forecast for a very impressive 30% growth in earnings per share for the foreseeable future. Are you guiding analysts purely on organic growth, or is there an element built in of contribution to come from future acquisitions?
Again, I'll pick that up. So the guidance to the analysts, and Paul in particular, was we're going to prudently forecast a 25% organic growth in the revenue line, and then clearly, as it's a fixed cost business, we have some optionality around how much investment we put back into the business in terms of OPEX, and therefore what the margin is going to be. We've assumed that the margin is going to be flat to small decline, so the profit will grow, but that is all organic growth. In terms of future M&A, it's we continue to look at opportunities out there, but it isn't a key part of the strategy. If something comes up that's interesting, we'll look at it, but it's more reactive than proactive. There's a big addressable market that Pat's already described to go after, and therefore we want to focus on growing into that organically.
Okay, we have a follow-up question on acquisitions, which I think you partly touched on. But if you do see an opportunity, is it more likely to be by product-led, i.e. acquiring technology, or will it be led by your desire to expand in certain geographic areas, or perhaps a combination of both?
So that's Pat. I'll grab that one, give him a break. Re-emphasizing what Jug just said, M&A is not the pointy end of our spear. We have a large addressable market that we need to grow into, and our efforts are going to be organic at getting that done. As we look around the world, we do not want new product ranges. We want to invest in those that we have already invested in. And as we consider opportunities, if they present themselves, almost all of it would be important to us. Geographies would be important to us, maybe technology enhancements, real revenue. That whole combination would be important to us. I would also like to emphasize that with Blancco's core metrics and Blancco's operating margins, there are very few transactions in the world that would be appealing to us. Most would be decretive in some way or another. They just wouldn't be as fast growing. They wouldn't be as profitable. They wouldn't have the same gross margins. So we have to be super selective. It's not that we don't look. It's not that we don't entertain the ideas. There's just very few opportunities out there for people to join our team. And right now we're heavily organically focused.
Okay, thank you. And a question on the marketplace from Jerry, Pat, I think one for you. Everybody is aware that it's a very fragmented market in data erasure software. Does that mean that you would consider your rivals to be divisions of larger groups? Are there any quoted competitors in America? Or is it more of a mama and papa industry where your size can give you a leadership position?
We definitely have the leadership position. I think as we've done the analysis, we spend more on R&D than our next three competitors have in revenue combined. So there are small companies around the world dealing with little niches. We are far and away the leader. We started as a leader in the ITAD industry. Our technology footprint today with things like live environment erasure and our mobile platform, which integrates diagnostics and mobile together, is very unique. Our reach around the world with 15 to 16 different sales offices also makes us unique. And then lastly, the certifications that we have from all the different entities around the world within the different jurisdictions that require very specific certifications, again, is untouched by anybody out there. So our market position is far and away the largest, and we intend to keep it that way.
All right, a couple of questions from Keaton. The first one is concerning your stock market listing. Have you contemplated moving onto the full London board, or are you happy that your profile on a global business is satisfied by the AIM listing at the moment?
Yeah, we've absolutely contemplated moving to the full market, but given the current growth and the ability to execute deals quickly, AIM is certainly very attractive at the moment. And in what we've seen over the last few years is that there's not been any sort of hold back by being on AIM as opposed to being in the full market. So we're getting investor interest aboard, so we don't feel it's holding us back. And our conclusion at the moment is we're good where we are.
And his second question, he has read of a patent dispute that is ongoing at the moment. Could you update on the status of that and obviously its potential importance to the group?
Yeah, with regards to patent or patent disputes, we are a software company, and we have our first patent, which is around solid-state drive erasure. We will continue to fortify our patent portfolio with a very professional IP protection process, managed outside counsel. With regard to what has been in the news, we haven't sued anybody and we are not yet suing anybody. We have identified several entities that we believe violate our patent. We approached one of those with a CEO to CEO letter, and they decided to run a little bit too fast, probably ahead of themselves, asked for the IP courts in Northern California to present a declaratory judgment. Lots of technical words here. We still haven't sued them. The courts are forcing them to have their code analyzed. We're not spending much money on this. See what happens as a result of the code analytics as to whether or not they violate our patent or they were just not being very clear about what they did with all their public-facing information. So for right now, there is no suit. We're being very, very practical about this, and we'll see what the courts bring in the next couple of months.
Okay, thank you. Jog, question from Dan on working capital, where looking at these results you appear to be in a fantastic position now. How might that change as you increasingly deal with larger clients who will clearly have a stronger bargaining position? How might that affect credit terms, or will the software nature of the business mean that you'll never have to take stock on board in advance?
That's a really good question, and I'm going to flick back to some of the slides in the deck to answer this. So I'm just flicked back to slide 20 to cover this. So the balance sheet is what's listed on this slide. It remains well managed and is not a capital intensive business. The numbers that I tend to focus on are the Blancco and capital numbers, which are broken out on the bottom right of this slide. And as you've rightly pointed out, Dan, there's no stock in the business and we don't need to hold any. What you can see is there has been the debtors balance, and that's coming from the fact that, as you say, we're dealing with bigger customers. They're writing checks for 100,000 or now even $1 million, and therefore they expect us to sell to them on credit. And you can see there's been a tick up in the debtor days. I do expect that trend. I do expect that trend continue. In terms of how we managed that in the period just gone, we were able to push out our creditors a bit, and then also you'll see the deferred income balance has gone up. I think that's a trend that we can manage, and therefore I don't think there'll be any significant drain on working capital, and the cash conversion will remain strong. The deferred income is actually quite important, and that represents future revenue and that's from our subscription business. So what you should really track is not just is the sort of debtor investment going up, but how much the deferred income balance is going up as well, because as you can see the income has been offset there.
Thank you. In terms of market drivers, Pat, Tony is curious, in your opinion, it's nice to have so many tailwinds, but do you think it's reputational damage that is driving corporates? Is it the threat of civil litigation, or is it the presence of regulation that is the most important driver for them at the moment? And following on from that, is there yet any evidence that the regulators have got teeth and are going to be punishing non-compliant corporates?
Yeah, great questions. I think a lot of the information security technologies, as they start to bite and take hold in the market, it's largely driven by regulation. Whether it's government entities around the world or corporations, they start to pay attention when regulations start to be applied and those regulations have teeth. And some of the classic examples for those would be the PCI style standards. They would be the healthcare style standards around the world. And really in the last 5 or 6 years, we've seen digital data destruction take hold in many of these, with PCI, with the new ISO standards, with the different healthcare standards around the world. The brand new EU GDPR mentions it 4 ways, including the right to be forgotten. So there's many different facets of regulations that are kicking on. We have just seen and had early evidence of some regulations that will start impacting the financial wire transfer industry. That's come up in the last week. Digital data destruction will be a hard-coded part of that. We are also starting to hear wind of SEC cyber laws and regulations out of the US, which will also have teeth. So for us, those are primary motivators. I would say that as they start to kick in, though, it does raise awareness. And there aren't too many corporations that want to be found wanting with data that is sitting around that should not be there, that gets hacked and puts them at reputational risk. So all of them kind of get together. The last thing I think that's helping us that creates the tailwind, organizations like Gartner who are starting to talk about data sanitization and have us on two separate hype cycles today, one being privacy and one being data security. All that combined raises the awareness within CIOs and CISOs around the world.
Great. Last question comes from Kimberly and is on a forward-looking basis. You very neatly explained the phenomenal opportunity from integrating diagnostic and Erasure capability. But what pace of adoption are you expecting from that? Is that going to be a driver in 2017 or 2018 growth?
Again, this is Pat. I'll grab that one and John can finish it off if necessary. You know, while we're not calling out the individual product sets and their contribution to growth, it is absolutely something that internally we're heavily focused on in training our sales teams and specific training curriculum around the mobile device upgrade marketplace. The nuances of that are interesting because it's done slightly differently in different markets of the world. The way things are traded in the United States is different than it's done in China, is different than it's done in Europe. So it's a fast-moving environment. It takes a lot of training and education, but to be clear, it is large, and we all know, evidence of exactly what's happening today. All these phones are changing hands because people want the latest and the greatest, and the second-hand phones have a large value. So we want to be right there in the thick of that.